Okay, my name is Connor McKenna, and this is my financial analysis of Walmart. So, Walmart today is a staple of what seems like just about every town in America. This superstore is woven deep into the fabric of American consumerism, and many of us couldn't even imagine life without it. However, it has humble roots dating back to 1950 when Sam Walton opened Walton's 5 and 10 in Bentonville, Arkansas. His vision was to drive a large sales volume in order to provide his customers with lower prices than his competitors. He went on to open the first Walmart in 1962, and from there the chain took off at an unprecedented rate. It spread throughout the southern United States and then the rest of the country, with stores in every state and Canada by 1995. Along the way, new formats of stores like Sam's Club and the Supercenter were introduced. Today, the company operates over 11,000 store locations in 28 different countries. The merchandising chain offers every type of product one could imagine, from groceries to automotive parts, and just about everything in between those two. It's also recently expanded into e-commerce, allowing customers to order online and pick up in store or have their order delivered to their homes. This recent online expansion is in response to the ever-growing threat to retail that is Amazon. Walmart is responding to this threat in a big way, and they're even predicting 35% growth of their online business in 2019. Online now, they're currently selling mostly groceries, which have lower profit margins, so they're trying to expand their online sales more into apparel and home products. They're also investing lots of time and money in improving their methods of online sales and their delivery teams. This leads me into my first current event, which is they just announced the launch of their new in-home delivery for groceries. This program allows people to have groceries delivered not just to their home, but into their fridge, even when they're not home. Also, they just announced that they saved $1.6 billion in taxes in the year following Trump's controversial tax cuts. And they also announced that they're planning to invest $1.2 billion to upgrade the logistics of their supply chains and their distribution centers in China. So for 2018, their return on investment was 10.36%. This is a measure of their profitability and efficiency. And it was slightly lower than the average retail return on investment of 14.31%. So that's not ideal. Their profit margin ratio was 4.3%, meaning that they made just over 4 cents for every dollar of sales that they had. And they had 2.41 asset turnover ratio. So for every $2.41 of sales, or they had $2.41 of sales per dollar of assets. Here's the horizontal analysis of their income statement for the 12 months ended January 31st, 2019. So as you can see, from 2018 to 2019, their total revenues and as well as their operating income actually did increase the operating income by a significant 7.44%, and that's a good thing. However, their consolidated net income declined by almost 32%, which is very concerning. And obviously this translated over into the net income per share attributable to the company decreasing by about 30% as well. So for anyone looking to invest, this is very troubling. And then here is their balance sheet with their and a horizontal analysis of that. And again, and their current assets went up, as did their total assets. But you'll notice that their property and equipment actually decreased from 2018 to 2019. And a possible cause of this, even though they were expanding their total assets, is that they were moving some of their operations online as opposed to the physical stores. So they lost property and equipment while still expanding their total assets. So for the liabilities and equity, the numbers that really jump out here they paid off almost 50% of their long-term debt within 1 year, but they also added significant long-term debt, 44.85%. So that's something that they're investing or whatever they're looking to go expand going forward. And their total shareholders' equity went down by 6.9%, which is also somewhat troubling, but all the other numbers seem to be pretty normal. And the vertical analysis of their income statement yields a lot of the same results. As you can see, the revenue and operating income took up larger percentages of their totals in 2019 as opposed to 2018, larger percentages of the totals of the total revenue, which is a good thing. But when you go down and you look at the consolidated net income, it took up a much smaller portion, which is very troubling for the company going forward. And for the assets on the vertical analysis of the balance sheet, you'll see again that from 2018 to 2019, the percentage, you'll see the same trend as in the horizontal analysis, with the assets becoming or the property and equipment becoming a smaller percentage of assets. And you'll also notice that something positive, that the cash and the net receivables are trending both in the same direction. And this is typical, but if they weren't doing that, it could be a red flag that something was wrong, but they are, so it's a good thing. And then here with the liabilities and equity vertical analysis, you'll see that the total equity dropped, and this is from 2018 to 2019, took up a smaller portion of the total. So this is also somewhat concerning. And then for the competitors, there isn't really one company that competes on the same level as Walmart because of just Walmart's scale and variety of products. But for instance, Home Depot competes somewhat on scale, not quite as much. And with the hardware section of the store, Costco competes with obviously Sam's Club, and then partially with the grocery section of the regular Walmart stores, and then Amazon is their main competitor online. So I'm going to do common size statement analysis for all three of those. So for the income statement, Walmart kind of falls in the middle ground for cost of sales. Obviously, Amazon has the lowest since they don't have the physical distribution centers making up their part of that cost. And then they have more in their operating and administrative expenses, Amazon does, than the other three. But Walmart is solidly in the middle for both of those. But it is, and for operating income, Home Depot's way ahead, but Walmart is a little bit on the low end. Would like to see that be a little bit higher. And for consolidated net income, they're by far the lowest out of any of their competitors for their most recent one-year filing. And then for the balance sheet, the common size statement on the balance sheet, they had the excuse me. Again, they had the lowest total current assets, or lowest percentage of total current assets, and then property and equipment, they were between Amazon at the lowest point and the other two at the high point, which was to be expected. And then for current liabilities and debt, Again, they're kind of in the middle ground just because of the nature of the differences of the companies. And then they had less retained earnings and less or higher percentage, again, middle ground total percentage of total equity. And then for some of these, so we'll start with their liquidity ratios. Their liquidity is very poor overall. And this starts with the working capital. They actually have negative working capital because they have more current liabilities than current assets by over $15 billion. So all the ratios beyond that, the cash ratio, acid test, and current ratio are all much lower than you would hope to see if you were going to invest in a company, because they don't have an ability to pay their short-term debts if they wanted to. If all their liabilities came due at the same time, like is calculated by the acid test ratio, they couldn't even come close to paying them. So this is obviously something that Walmart needs to work on. And then their solvency ratios are not as bad as their liquidity ratios in evaluating their ability to pay their long-term debt. Not quite as bad as the short-term, but still not where you want them to be. So with the debt ratio, this shows that 63.81% of their operations are financed by debt, which you would like to see be significantly lower. It's not as far from the average as with the liquidity. And then debt to equity, again, is slightly higher than you want because they're financing more with debt than they are with equity, which makes it a riskier investment. And then with the times interest earned, they're above average with their times interest earned, and this shows their ability to pay their interest expenses, which they should be fine with. So they have that going for them. And then with profitability, they're a little bit on the low end. Their profit margin only being 1.41%. So they're only earning just about 1.5 cents of net income for every dollar of sales that they're making, which is less than you would like to see. And then their rate of return on total assets being 4.39%. They're not doing a great job of turning their assets into profit. It's not horrible, but it's slightly below. And then the asset turnover ratio, they're getting $2.4 of revenue per dollar of assets. So they're doing a fair job, an average at best job of turning their assets into revenue. And then with their rate of return on common stockholders' equity is fairly average at 10.89%. But as you'll see with earnings per share, they're down to $2.45 per share in 2019, or in the period between 2018 and 19, which is down from $3.51 in 2018 and $4.61 in 2017. So they're trending straight downwards at a rapid level, which should be very, very concerning for potential investors. So in the end, though we might think of Walmart as being in a category all by itself, like leading the industry, doing whatever, which it certainly seems to be, the numbers seem to suggest otherwise. Walmart might have a bigger presence than any of these other retailers, but it is nevertheless starting to see declining net income numbers, which is leading to less earnings per share. So it'll be interesting to see how successful Walmart is moving into e-commerce, and maybe they can start to get their numbers back on the right track with that division. But for now, it seems like they're on